Hello, the stock market is volatile, but given a long enough time horizon, it seems like a can't lose proposition in that your investment always grows over these long time horizons, which raises the question, why wouldn't I want to borrow money in order to be able to invest more and grow my wealth even more? Well, it turns out you can do this. You can borrow money kind of on margin or with leverage, two different terms for doing so. Let's take a look at this. So if we would have invested $10,000 in 1927, it would have grown to nearly $2 million as of today. Now, yes, this includes the Great Depression, the 87 crash, the internet bubble, the financial crisis, etc. So despite all this volatility, our wealth grew considerably. So why wouldn't we want to borrow an additional $10,000 in order to invest $20,000 in the stock market? If we'd done this leverage proposition, our wealth would have grown to nearly $3.9 million. Now, of course, this is a little bit too good to be true because you have to pay interest on your borrowed money. Now, if we had done this at a 7% interest rate, then our wealth would have actually gone negative to nearly $2 million. Okay. Now, of course, you're saying, well, look, Brian, you started in 1927. That was right before the Great Depression, and that is a big cause of this problem. Of course, you're right. So what I want to do is I want to look at starting at every single year since then. Okay. So if we start again kind of in 1927, so we do it at the end of the year, and we do it at 0% interest rate, then we are better off leveraging 100% of the time. Now, of course, we cannot actually borrow money at zero. Currently, margin rates are at 7%, actually a little bit more than 7%. And those are probably at all-time lows given today's interest rate environment. But let's go ahead and look at this. So once we get to a 3% interest rate, then our success rate drops to 96%. Okay. Now, if we then jump up to this artificially good 7% interest rate, given that we're at all-time lows, then our success rate drops down to 60%. So all the red here are the years if we had started this strategy where we would be worse off with this leverage strategy. Now, another problem we have is there are certain margin requirements. So the idea here is that your portion of the investment needs to be at least 30%. So there's maintenance margin requirements, which means once your portion drops below 30%, then you have to start paying back some of this money that you borrow. So for our purposes here, once our wealth, which was at 20,000, that's the 10,000 we had plus the 10,000 that we borrowed, once that drops below $14,285.71, then we get a margin call. So we're going to say that that's a failure in this strategy. So if we do that, once we get to this 30% maintenance requirement, then our success rate drops all the way down to 55% of the time, where we were better off with the leverage, and 45% of the time where we're better off just not even bothering with the leverage. This is not a very good hit rate. I think a lot of times when you see these things that seem too good to be true, you want to do the full analysis here. To my knowledge, I've never seen anybody do it quite like this. I think it's an interesting case study. Keep in mind that I'm using annual returns. And if you actually did the strategy, that you would have daily volatility. So you would have hit probably, those negative success rates. Things would have been worse. You would have hit margin requirements more often, et cetera. So this is kind of the best possible case scenario given the history that we've seen. I hope you found this informative. Thanks so much for listening.